Did you know that you can buy property and legally accelerate the depreciation to reduce your taxes without refinancing, selling, or even losing cash? This is what is called cost segregation. You might have heard it here and there from TikTok videos, from YouTube videos, from actual professionals. But what I want to do today is I kind of want to break down what is somewhat of a difficult and complicated segment of a strategy that you can use to reduce taxes. So, what I like to do is in these videos is just kind of really get down to a summary or speaking a language that it's understandable to an average person, right? Because when we talk about, there's all these things that go in terms of tax terms, that goes in accounting terms, that we in our industry we use in a daily basis. But when what you really want to know is like, does this really help me? How is this gonna benefit me? You're throwing all this lingo at me, like depreciation and accelerated depreciation and 100% depreciation. But what I really want to know is how does that affect me? First of all, second of all, like, okay, so if it's a strategy, how do I use it? And even more importantly, it's like, so if I use it, what do I get out of it? So today I want to talk a little. I want to kind of get down to the more of a granular level of what we're talking about here. So, you probably hear a lot of people talk about cost segregation, but you just hear about it. They'll tell you, do cost segregation. It will help you, but it's just words, right? You're not gonna have a clue what this really means, and without knowing what it means, you don't know how it's going to help you. So what I want to do here is I want to create an understanding, a simplified understanding of cost segregation. So and it's important to understand how this works and how that's going to benefit you. So I'm going to talk in a very summarized way, right? Because when we talk about something like cost segregation, there's a lot of nuances and there's certain things that, go beyond the scope of just a simple strategy. But today I want to just give you the simple summary that, at the end of the day, what we want to do here is I want you to have some understanding, some level of understanding what it is, how it works, so that you can talk to your accountant, right? Because this is like a high-level strategy that, without even you thinking about it, it might trigger you to think, okay, well, it's something I could use. I'm gonna talk to my CPA and see if it works for me. Okay, so how this applies and who does it apply to? Those are maybe the basic questions, right? So when we talk about cost segregation, we're really talking about mostly in the real estate world, okay? So who is this ideal to? So there are some main players here who are kind of going to be part of the whole cost segregation world, right? So number one is real estate investors, okay? So, usually the whole concept about cost segregation goes in line with certain strategies that you can utilize using real estate, okay? Number two is short-term rental owners. So, if you have some money put aside that you're thinking about investing, that you like the real estate, there's so many investment opportunities, but if real estate is one that applies to you, that you think it's something that you would enjoy or that you think you can benefit from, this is a strategy that will definitely apply to you. So developers and flippers, right? In some cases, not every time, but developers and flippers can definitely benefit and are players in the whole concept of the cost segregation. So business owners who own their building, not just people with million dollar portfolios, right? This is the biggest misconception is people think that, I just own a $300,000 home. I don't, cost segregation doesn't apply to me. It's the biggest lie. It's actually, you might even be, in terms of percentages, you might even get a bigger benefit when you have that type of investment rather than millionaires trying to get this, especially because there are certain thresholds that you have to meet to qualify. So you might actually get disqualified from this. So that's basically those are basically the players, right? A real basic world. Those are the kind of what we're talking about here. So what is the number one question I get is, what does it cost? So it's cost segregation. It sounds expensive. So cost segregation, it's one of those things where if you do it correctly, the amount that you're gonna spend to get the cost segregation, because there is a cost, is gonna be minimal compared to the benefits that you're gonna get. So when it comes to cost, think about the value that you're gonna get for it, and the value could be thousands and thousands of dollars of benefits. When you buy, so let's say, just to give you just a very basic, right? Let's say you buy a building. The IRS normally makes you depreciate it over time, right? That's the whole concept of depreciation. And you're going to hear me talk about depreciation quite a bit because basically we're playing here around the concept of depreciation. And just to give you a basic background of depreciation, if you don't already know, because what it comes to that is, first of all, if you own real estate and you don't know about depreciation and you're working with a CPA, I would make sure that the whole concept of depreciation is being applied to your process at the moment. And then number two, that it's being done correctly, and number three, that maybe that you get some understanding, right? Because here at Upfront CPA, one thing that we like to do is we like to educate our clients. It's very it's one of the challenges that that we try to overcome is some of our clients sometimes were sort of blindly dependent on their accountants or their CPAs, and they didn't even have an idea of what was being done for them. So one thing that we do here at Upfront CPA is we try to educate our clients to make sure that they know what's going on, okay? So I know that there are different levels of, let's say, understanding when it comes to this, especially technical issues. But at the very basic level, we just try to get the basic understanding of what we're trying to achieve, right? One thing that we try to do here is that you see the value of working with us. It's very key for us here at Upfront CPA. So when it comes to depreciation, basically the whole concept is, when it comes to assets that expand over a certain period, the IRS allows you to expense it, but not right away, right? What that means is, let's say you buy, we're talking about real estate, so I'll give you just a live example. So you buy a house. The house, the IRS gives you a baseline of how long a house will be useful to you. Okay, so they'll say, okay, so if a house is something that you're gonna own for a certain period, you have to allocate that expense to that time. You can't just, I went in and bought $1 million house tomorrow and I'm gonna get to expense it tomorrow. That's not how it works. So it's basically applying the expense over the life of the asset that you bought, or that you're planning on buying. So when we're talking about periods, is usually as of the time of this video, the IRS, when it comes to residential property, is 27 years and a half, while residential properties is 39. So you can see right there how broken down the expense is, right? So just give you an example. If you bought a $500,000 house, so you have to expense that over a 27 and a half period to get that expenses on a yearly basis. So when you're looking at it from that perspective, the impact is not that much, right? That's where cost segregation comes in, and we'll talk a little bit more about how that really works and how the cost segregation helps. But so you got your real estate, you got your depreciation. So now we bring in cost segregation. So basically what happens is, in a home or in a property, just to give more context into the real estate, you don't just have the home, right? The home, or when you think about the building itself, we're looking at just one unit. But if when we look at it, the one unit is made up of different components, and that's what cost segregation does. So if you kind of think about the wording, is cost segregation. You segregate these things so that you can use it for your benefit. So there are different components to a home, right? There are carpets, cabinets, there's parking lot, there's sideways, there's landscaping, there's the structural, there's the walls, the foundation, the roof. All of these things is what make up the house or the property. So what we want to do in cost segregation is to say, okay, so which one of these are long term, which of these are not long term, that we can expense in that gets expensed in a less span, right? Because if you think about it logically, the roof is not going to last the same as the parking lot, or the walkway is not going to last as much as the foundation. So all of these things have different lifespan. So what we want to do is play with the timing of each of these components to make sure that you get the right depreciation. So basically how it works in a nutshell is you reclassify the items from short that have the short term, right? You accelerate the depreciation, you increase deductions, and you lower taxes. Basically, that's the whole concept behind the cost segregation. So I'll give you a little bit more into that, but in a basic level is you shorten the span, you accelerate the depreciation, and you end up with less taxes owed to the IRS. This is a formula that works. That it's not something that it's made up. It's not something that you're playing around with the IRS to get a shortcut or something you're not supposed to. This is 100% guaranteed, approved, and within the IRS code. So you're not doing anything illegal. You're actually doing. You're actually going by what is being provided to you. Okay. I told you about how this works, and I told you about the depreciation. So now let's talk about the bonus depreciation, because this is a big concept here. Because for the whole cost segregation, for it to work, for the whole idea to work, one of the key components here is the bonus, and I'll get in more into how basically that kicks in the whole concept, where it just makes it from maybe something that looks good into, wow, this is like a must-have. This is something that I cannot miss. Okay, so this is where the savings hit big. This is when you hit the home run, right? In the tax world, we're so used to just hitting singles and doubles, which, it's a good strategy. It's conservative ways to get things done. But with the cost segregation, it's just thinking of it in those terms. It's hitting a home run, basically. So with the bonus depreciation, when you combine that with the big beautiful bill, which, if you've probably seen some of my other videos, we talked about how the big beautiful bill brought back the 100% depreciation, right? So we talked about the 27.5 year span of the properties, the 39. Those are long-term properties, right? So what the big beautiful bill said, okay, so if you have a shorter term, some of those 5 and 7 and 15 year lifespan properties, those you get to expense it on year one. Okay, this is the key ingredient here. This is what kind of kicks in that tax saving that is really gonna make a huge difference if you do it right. And let me emphasize that if you do it right, this is what is gonna bring home that big saving. Okay, so let me just give you like a high level example, right? So let's say you buy a $600,000 rental property, right? Let's say you go to your cost segregation specialist. You say, hey, I just bought this new home. I got this. You're gonna call them. You're gonna say, just bought this house. I bought this property. I want you to work on that cost segregation study. So usually how that works is, they're going to ask you a few questions. They're going to ask you quite a few details about the home, because there are certain criteria that you do need to meet, right? This is not just I just looked at the property and just eyeball things. No, this is like a real concept, so it has to have support. You go through that process, and then the next is, so you bought the house, right? So you have that so let's say you have $90,000 in 5-year components. So we talked about the short term and long term, right? We talked about that the short term is your carpet, your cabinets, your fixtures, all those type of things around the home. You got your parking lot, your sidewalk, your landscaping. That's the 15-year lifespan. While your carpet and what I said earlier is really a 5-year plan. It has a 5-year term. The parking lot and all that's more of a 15-year. Then the next year is the actual structural part of the home, which is your 27 and a half lifespan. Okay, so let's say for our example, let's say you have $90,000 in that 5-year component, right? Let's say we go to our cost segregation specialist, we identify that $90,000 in those as part of that short-term lifespan, right? And let's say that you have $30,000 on the 15-year on some land improvement, okay? So if you add those up, you have $120,000 in total accelerated depreciation. So let me say this again. On this very basic example, we're talking about $120,000 in accelerated depreciation. So let's say you're an investor and you're in somewhere in the 32% tax bracket. We're talking about upwards of $38,000 on tax savings, right? I'm talking about very high level, right? To make that happen, there's a lot of granular stuff that we have to do in terms of breaking it out and doing the actual tax filing correctly. But just high level, which is not something completely crazy, just with a $600,000 home, which could give you those numbers. Obviously, after we talk to our cost segregation specialist that can confirm that, we're talking about somewhere of the $38,000 tax savings just right there on that very basic example. So I'm just giving you just kind of like the land, a layout of how it works, right? So now I want to talk about a real key aspect here, which is who actually uses this strategy, and who uses it and who benefits. Those are two different concepts that I'm gonna get to. And besides, so one thing I want you to think about is there's two components here. It's do I understand how this works? Is it gonna benefit me? Does it have any benefit for me? And if I end up doing it, I need to do it right. Because one thing that we emphasize here at Upfront CPA is we like to go over all our client strategies, but we like to do it right. Because the last thing that we want to do for anyone, especially our clients, is just give them some basic idea about some potential strategy and either just let them do it, then let them figure it out, or just not do following the proper ways to make sure it sticks, right? To make sure that it has that it follows all the guidelines so that it works. So I say this obviously because we've had plenty of examples of clients that have come from other firms and have gone through this exact situation where it's like, okay, my tax preparer, told me that I qualify for this, or I looked at it in TikTok and my preparer said that it sounded like a great idea, and I ended up filing my taxes and I got this big fat letter from the IRS asking me that I'm getting audited, or saying they're asking me all these questions that I don't know and I need you to help me. So basically we try to avoid, that's our number one, it's one of our main goals here, is to avoid any all these things are never guaranteed, but we definitely follow the right guidelines, and we make sure that all these things are done properly to avoid unnecessary issues, right? So I want to talk about which a part of the cost segregation realm that most videos that I've seen, or most people that they talk about, they don't talk about, which is how you can either maximize your tax savings or get frustrated because it turns out that this deduction does not work for you, or it's not going to do anything for you, right? And when we talk about taxes, I'm always careful when I do these videos, because all these things it's not like it applies to everybody, right? And it's one of the reasons why at Upfront CPA we meet with our clients regularly, because when we talk about this type of strategies, we make sure that it's something that it works for them. Okay, so when I began the video, I kind of laid it how it works. I gave you the basic information about what this is, but it takes experience and knowledge about how this works to make sure I know if it's gonna apply to you. This is not a strategy that applies to everybody, unfortunately. And I'll get into more details about that shortly. But it's something that you need to be skeptical about, right? So just to give you an example, maybe when you go to your tax preparer that may not be a skillful CPA, you say, hey, I heard about this strategy. Can you confirm if it works? Can you just walk me through how it works for me, right? So that they can explain, so that way you can ensure that that it's not like a silver bullet advice, but something that they know that it works in your case. Okay, so we talked about depreciation, right? And when it comes to thinking about, does this work for me? We need to talk about passive versus active income. Okay, so whether you're sort of a W-2 employee, or if you're an independent contractor, or if you own your own business, this is where the passive versus active income concept comes into play. Okay, so if we talk about it in general terms, and we follow kind of like how the wording says, when we think of active, it's we're involved, right? When you talk about passive, it means that maybe you're just sort of sitting there while the magic is happening and you're just kind of just waiting for your paycheck, right? That's basically how active versus passive basically that applies in the real world, okay? And when it comes to taxes, it's just basically the same thing, okay? So why is it important to separate the two is because active income and passive income will have different tax outcomes when you file your taxes. Okay, and there's a whole video about how active income and passive income, how those two work with each other, and how different strategy might work, and combining the two. But for the sake of this video, we're just talking about how depreciation is a passive part of the income. Okay, So if we're talking about it in general terms, okay, depreciation from cost segregation, we're talking about in passive terms. Okay, so let's say you have a loss when it comes to a cost segregation, unless you do certain exceptions that we're gonna talk about in a few minutes. We're talking about a strictly passive that is not that is not gonna have any effect or barely any effect on the active side. Okay, so and I'll do a video about this difference between the two and how these two combine on a later video. But for now, we're just kind of considering just to separate the two. Okay, so and why I keep emphasizing this is because the cost segregation, the whole cost segregation strategy will not automatically reduce your taxes unless you meet certain exceptions. And it's how we take this passive strategy and we get it into the active side. Okay, that's basically one of the goals that we try to do here, right? It's not like every income needs to be active, because that's not how it works. But when it comes to cost segregation, there is some component of some of that passive income that you want to bring to your active income, or loss, right? Or let's say having those losses reduce your income. Okay, and this is especially a good strategy when you combine, let's say one of the spouses having W-2 income while the other one has some of that passive, is doing some of that passive income. It's involved in that type of work, right? Which is it's usually common for that to happen, right? Especially for higher earners. Usually you'll have one of the two members of the household just more doing a 9-to-5, or a strictly type of hourly, having to complete office hours type of work, while another one might be more independent, whether that's being a realtor or just doing consultant somewhere work, or it's just simply kind of more handling the investments in the business, while that makes it passive, while those businesses are generating that type of passive income. So I want to talk to you about the exceptions. Okay, so the exceptions are big. This is kind of where we're gonna pass some of that passive income and we're gonna move them into the income side. So the exception number one is the real estate professional status. Okay, this is something that surprisingly for me, a lot of my clients who are realtors did not know about. This is something that it's such a shame that when we're talking about let's say the real estate license, that we don't have, unfortunately, when they do their courses and they get through the whole real estate licensing, they usually this is not something that is highly included as part of their training. Right. Usually they leave, it's all of these tax limbo and all these tax situations is usually left for accountants, which, it can be good, but it also can hurt you. So, and so when it comes to a real estate professional, and if you're a real estate professional that has a license, that is an active realtor, you are considered a real estate professional. Okay, so you have that status as a real estate professional, and I'll talk a little bit later how that has an impact. But to qualify for a real estate professional, you do have to follow certain requirements, right? Like you have to hit your 750 hours plus hours per year on in real estate activities, right? Whether that's showing homes, whether that's taking clients to properties, whether that will be even sitting down or doing a video like this, talking about the real estate and how it's changing and how that might have an impact on your clients. All of that counts as real estate activities, right? And it has to be, so that's number one. Number two, it has to be more than half of your total work hours, right? So for you to qualify for that real estate status, and it has to be real estate activities, right? Obviously, it's not going to work if you say you're doing a real estate, but you're doing something else, something completely unrelated, like doing Uber, that's not going to count. So that's number two. Number three is material participation in the rental. So you do have to be involved in what if, let's say, you own a home and you're renting it and you're using that real estate professional status. You do have to be involved as part of the management of that home. What is this ideal to? This is ideal for full-time investors, right? If you're considering investment as a full-time into real estate, this is perfect idea for you, perfect strategy for you. Realtors, brokers who manage their own rentals, what I just talked about, this is for you. And spouses where a W-2 and the other one runs real estate. This is exactly what we just talked about earlier, right? Which is quite common, especially these days after COVID, when people are more rationalizing and just being more careful about, or more than careful, we just seem to have more options when it comes to work, right? It just seems like, especially after COVID, we just have a lot more options of either working remote or being an independent contractor, or having just one spouse having been a W-2 earner while the other one can just kind of go off and maybe do more independent work, or just kind of do more of something in the real estate. Okay. So just to give you a visual examples, right? So let's say that one of the spouses who owns is a W-2 earner, makes $180,000, right? While the other one is has that real estate professional status. And let's say they decide, you know what? I am gonna use this strategy. I am gonna call my cost segregation specialist, and I'm gonna get that beautiful number that I want. I want that accelerate depreciation to work for me this year. So let's say that after all the work that takes to get there, because I'm just gonna be honest, it's not like it's just the next day you get this number. It does take some work to get there, but it's completely doable, and something that if you work with a real professional, someone that knows, whether that's a CPA or you go directly to it's always good to have a good CPA to be part of this from the get-go, because all of this is going to simplify the process and in the end make it easier for you. But if let's say you don't, you can go to that cost segregation specialist and they can work with you, and then work with the CPA to make sure that whatever the study was, that is done properly on the tax filing. So so let's say, just in a simplistic way, let's say this household makes $180,000 between the two, right? So we get that cost segregation cost, and it will give us $120,000. It's 120, right? We say we bought a home, we took it to the cost segregation specialist. They come back, you get the $120,000 as part of the cost segregation cost. Guess what? You're reducing. If you do it right, and you qualify for this status, you can reduce that 180 by 120,000. So I don't know many strategies that can just outright just do that for you. This is something that you do really need to keep in mind, and you do really need to talk to your CPA about. So it's completely life changing. Okay, so clearly you do have to meet with somebody to make sure that, or the right CPA to make sure that it works for you. So that's not the only exception, though. There's another one, and it's called the short-term rental loophole. I'm adding the loophole here because that's not obviously how, as part of the name, it's just a short-term rental, but it is a bit of a loophole. And I'm just saying loophole a bit because it sounds like it's not something that is so legal, but it's a loophole. It's completely legal. You just need to know how to use it, and you need to make sure that you qualify. Okay, because there is a pretty strict criteria here that you do need to follow to fall under that category. So this is huge, right? And at the same time, it's misunderstood. But it's just basically how the name says it, right? You just need to be part of your home cannot be, or your property cannot be a long-term rental. So it's not a 2-year contract. It's not a 3-year contract. It's not even a 1-year contract. It's the Airbnbs, the VBOs, that you rent for a short period, right? So for this to work, so short rental. So how do we define that? So it's basically average stays is less than 7 days. And this is important, right? Because it's average. So you need to average this out. I will do a whole video about how this works, because there's quite a few components. But at the end of the day, you just need to average less than 7 days of rentals. Okay. To be a short rental, to qualify, you also need to be materially participating in it. Right. Similarly, as the previous exception, you do have to be involved in the property to qualify for this exception. Okay. So if you meet, if you kind of high level meet these two, we're talking about the same thing. So we're moving from the passive into the active. If you don't qualify for the real estate, the short-term loophole is a good strategy to use, but it's not a reactive strategy. Something that you need to plan to make sure that it qualifies to you. So similarly as the previous exception, it can offset W-2, it can offset some business income, capital gains, active income. It's one of those powerful tax planning and strategies available that you can use, that you can use today or plan today, and as of the time of this video, we're closing towards the end of 2024. You still have time to make it work. But if it's too late or it's something that you're starting to plan, the timing is. We as CPAs, when we're doing tax planning, there is a timing component. But when it comes to this, no matter when you do it, you're always gonna get a benefit. But you have to do it as part of a strategy, right? So even though the timing might be open to when you try the strategy, there is a timing component to make sure that everything that falls under the cost segregation strategy that you're doing all at the same time. That's important. Okay, so so that's that. Those are basically the two biggest exceptions. And what I like to kind of say after this is, if your CPA isn't reviewing your participation status, if they're just giving you blanket advice, if you say, hey, like cost segregation, we'll call some, not a very professional or not an expert in cost segregation. Maybe someone that we found off of Google that. Or where someone in Craigslist that says that he, has some experience in the cost segregation world, and we don't. So if we don't use those type, if we don't talk to professionals, if we don't do it right, the right way, and your CPA is also not involved and is not an expert in cost segregation, and it's not doing everything properly. It's not it's not checking off on your participation status. It's not talking. It's not involving, or it's not involved with, and it's not including, and it's not advising. It's not reviewing how the income type, the ownership structures. And it's just basically, if it's just giving you a basic blanket advice, is something that you need to be aware of. Okay, so it's one of those where the benefit is there, it's clear, it's night and day, but it has to be done the right way. Okay, there's quite a bit of information out there. You can even maybe put some stuff on ChatGPT. Which a lot of our clients just come with information with ChatGPT. But one thing to remember is in artificial intelligence it's a tool, right? It's not they know it all, or just throw some stuff out there. It's gonna give you some strategy that applies to you, right? Unless you're kind of skillful in how you use some of these tools. It's just basically the garbage in, garbage out concept, right? It applies the same way to the artificial intelligence. So something to be mindful of. So yeah, now I want to talk about another important part, which is when cost segregation makes sense and when it doesn't. Okay, so something to consider here. Because as we're talking about these things, is now we know that it works. Now we know what it takes there. Now we know the exceptions. So now the important question is, does it make sense? So as part of the does it make sense question, I want to just throw some best case scenarios, right? Let's say you purchase a home somewhere around the $300,000, right? Usually some rule of thumb here. It's newly built, okay? It's newly built and newly acquired, okay? So let's say you're in a high tax bracket, okay? It's another important concept that becomes part of the equation. So properties with high land improvement percentage, right? So let's say it's a home that goes a lot into it, right? When we talked about the 5-year lifespan of the versus the 15 or the 7, the 15, the 20, let's say all those components, and there's that, and there's also the land improvement, right? So that's when it comes to creating the garage, or the drive-through, the sidewalk, all of these things, right? So those are the best case, right? Because the more that you put the more of all that it becomes part of the cost segregation study, the more that you're gonna get back. Okay, so those are the kind of the best case things that we need to look out for here. Certain pitfalls, certain things that this is where the watch out type of thing, right? Where you can kind of determine who's kind of really an expert in this, and it's actually thinking about whether that works for you. These are the red flags, right? So low income years may not be the best time to use a strategy like this, right? You may actually waste losses if you don't on certain periods. Okay. Another huge concept, and it's actually something that came up in my firm just a short time ago, from a new client that came in, and again did the cost segregation 3 years ago on his property. Didn't get the right advice. It was just going with the flow, and got a pretty good cost segregation cost study that was applied to their taxes. And we're talking about someone here that was used to paying somewhere upwards of $70,000 to $80,000 a year in taxes. Actually got a refund for $30,000 one year, and basically just out of the blue, without thinking it through, just a few years later decided to sell this property that he applied the cost of segregation to. Terrible mistake. Now, I'm not saying that this is not something that you could do, because if you do it right, you can do it. But the problem is that this person did not do it as part of a strategy. Just basically did not think it through, decided to sell the property, did not have a plan for it, and unfortunately, later came to know and to understand that there is this thing called the recapture, the depreciation recapture, where, in a long story short, you have to if you don't do it right, you may have to pay all that back. So properties likely to be sold within 5 years, you have that risk. So this is a long-term strategy. This is not a short-term strategy. Okay, so as you can see, as we're walking through the whole process, I'm starting giving you some ideas, right, how it works, and this is one where, you start with the concept, you make sure it works. Now you're thinking about it long-term. Okay, another pitfall is not planning the record keeping. Okay, so, and this is important because the cost segregation study, since it's one thing that the IRS kind of triggers some of their inquiries, it's spikes, right? And in the example I just gave you, if someone is quite, regularly paying somewhere in the upwards of the $80,000 a year in taxes, all of a sudden is getting a $30,000 refund. That's $120 swing. Right, so this is gonna create an immediate red flag with the IRS, quite possibly. So you want to make sure that there's the proper keeping for this strategy. Okay, and my last pitfall to avoid for you is using a cheap non-CPA reviewed study. Okay, so avoid this cost segregation is not free. Okay, this comes with a cost, right? This is someone that a professional is gonna go into your house, is gonna review, it's gonna they have to have an understanding on certain areas. It's a professional that is gonna take time to put this together, so it comes at a cost. Okay, if you do it right, that cost it's pennies on what you're gonna get back. So my advice is, my high recommendation is, do it with the right professional. Do it with someone that is gonna give you a real cost, someone that is somewhat reasonable, right? It's not overly expensive. We're not talking about $20,000-$30,000 here. We're talking about someone in the range of $5,000 to $10,000 thereabouts, but that you're gonna get that huge benefit later. Okay, so what do we do here at Upfront CPA? We don't just tell you do the cost segregation, right? We don't just tell you to go do the study. We'll model it for you. We'll talk about the impact. We'll evaluate the risk. What I said earlier, we'll look at your income. We'll look at your whole structure, and we'll make sure that the strategy matches you. Okay, very important. So besides that, so now we get into the next step, which is, we talked about the whole recapture, right? And before you jump off your seat and get scared, let me talk a little bit about how that works, right? Why is this a long-term strategy? So I added this to this video just recently, because when I was reviewing what I was going to talk about, I immediately thought, okay, I'm talking about all the positive. I do need to kind of hone in some of the pitfalls and what, in my experience, why I want to explain why what could be a really good strategy can really hurt you if you don't do it right. So I want to talk to you about when selling is too soon, right? The whole concept of, okay, this is a long-term strategy, but what happens if, for whatever reason, I want to make it short, I want to get out, or, this is, for whatever reason, it didn't work. Not the cost segregation itself, but the property. And I need to, so I'm not down the long term for this one, okay? So let's say you're planning on selling the property within 2 years, right? If you're not using a 1031, I'm sure you've heard of this, or hopefully you've heard of this if you talk to your accountant often, is the 1031 exchange, right? And I also have a whole video about this 1031 exchange, but this is something that can help you solve that short-term versus long-term issue, right? Or if you don't have the real estate professional or their short-term status, it's also why you wouldn't want to sell short-term. So, and it's one of those situations that if you don't have these things going for you and done right, it might make the cost segregation process not to work for you. Okay, so when does it work? What's the flip side? Okay, so the flip side is now the complete opposite. Is you intend to hold the property long term, right? It's probably 5 years plus after everything's taken care of. The whole depreciation kind of comes to balance in the as part of the tax filings. The recapture, it's something that kind of goes out the picture, having to repay the whole thing. Then that's basically best case, right? It works for you on that sense, right? If you plan to refinance and continue to hold, right? That's the long-term the short term, right? It's not one of those, okay, this thing happens, I'm just gonna sell it. There are other options that you can always take, like refinance, that can help you hold it in the future for longer, right? If you expect income to increase in future years, it's a good strategy because you can either take that expense right now, you can break it out, however you want to break and dice it. But if you're expecting future income to increase or to stay, steadily, even slowly increase, is something that is gonna work for you. Great, okay. And then obviously what we talked about, the short-term rental, the real estate status, that's best case, that's gonna work, right? And if you're building a portfolio, right, we're talking about, it's the same thing, long term. We're not flipping houses here, okay? So basically that's the whole strategy. That's how it works. That's basically the in and outs, right? That's the whole concept of cost versus value. And that's when you're considering these things, when you're talking to your CPA, that's the type of discussion that you want to have, right? So as one of the last items, I want to talk about a little bit about the process, right? How it works and what it costs. Okay, so usually how it works is you analyze your purchase, right? That's the number one. Okay, so let's say you buy the property, and one of the biggest concepts here that we use at Upfront CPA is analyze, because everything we don't make decisions here out of the blue. Everything has a strategy behind it. So analyze is number one, right? They obviously do the cost segregation study, do it right, do the process. We already talked about that. You file. So one thing that you need to talk to your CPA about is make sure that you do whatever adjustments to depreciation that you may need to do. There's a whole concept behind it, right? This is where this is actually something that if you're talking to the right CPA, something that they're gonna bring up to you, although that's sort of technical that they might not. But just check with them, like, hey, is there any adjustment to depreciation? Because there are some filings that you need to do. Like one of them is, like, for example, like the Form 3115, which is the change of accounting method, right? This is a form that you may need to do as part of your filing to make sure that the cost segregation concept sticks when it comes to filing taxes, right? And then the next is, whether that's the short-term status, whether that's the real estate status, have that as part of your concept, right? So and then when it comes to cost, okay, so and I want to wrap this up here. I believe I kind of gone through the whole process. So lastly, I want to say, when we talk about costs, I kind of brought that up a little bit, but just kind of want to finish with that thought is, I kind of gave you all the value, right? All the money that you can save from the strategy. And we're talking about, in ballpark figures, is when we're talking about residential short-term studies for short-term properties, it can cost somewhere between as I mentioned earlier, it can go as low as $2,000, $4,000. We're talking about somewhere in a span of $2,000, $4,000, $5,000. Some of them may be a little bit more complex and might make it all the way to $10,000. But usually how this works is that more expensive the cost segregation is, the more that you're gonna get out of it. Okay. Now commercial ones are a little bit more expensive. Those are a little bit clearly a bit more complex. There are certain things that need to happen with the commercial properties that are requirements that don't apply to the residential and in and outs and stuff like that. So those are a little bit more expensive. So we're talking about maybe somewhere in the 10, 15, 20% higher cost. So yeah, I mean, this is basically high level concept about the cost segregation. I gave you the whole layout. I try to be specific in certain areas. I try not to confuse you in others. I try to kind of get down to the nitty gritty. And more importantly, I'm kind of driving you towards my goal here, which is think about how this works, but thinking in terms of, I need to talk to an expert to help me here. Over a video of whatever time I did spend here, you're not going to become an expert in cost segregation. This is years of work. This is like working with multiple professionals in the field and off the field. So, make sure that when we're applying these strategies, that you're doing it as part of a whole strategy, and talking with your CPA, talking with your financial professional, and getting the right help to get this to get this home the right way. So yeah, I mean, as a final thought, I want to say, if you own investment property and you want to find out how cost segregation can actually save you money, don't hesitate. Call your CPA. We're open here, Upfront CPA, for any questions. You can schedule a tax strategy with us. We can go over whatever ideas you think you may have about this, on how you think it might work. Here at Upfront CPA, we model the whole concept behind real numbers, real dollars, and real list of descriptions of how this whole strategy might or might not work for you. One important concept here is, do it within reasonable time too, right? Right now, so the time of this video, we're talking about towards the end of the year. We're still within time to, work for certain, see how that can get done for this year's taxes, right? For when we file next year, make sure that you can get these through, right? If you call your CPA next year, now you're talking about kind of going over the next year to get that benefit when you actually file your taxes. But like I said earlier, it's never too late to consider doing something like this. So thank you for sticking by. Thank you for being part of the Upfront CPA family, for listening to this video, for having the for having the courage to learn. Here at Upfront CPA, we're always trying to help our clients to get to the next level, not only help saving taxes, but also educate themselves while they go through that process. So if you like this video, make sure you follow us, make sure you click like, and we'll see you in the next one.